Hi, I'm John Mark Young, Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to the post 4th of July installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. Now remember, our aim is to provide you, our valued clients, a brief video giving you information that is helpful to your understanding of the markets while also drowning out the agenda of the news media in America. Now, when we think about the 4 things we learned in the markets this week, the first thing is we are definitely keeping a close tab on the Atlanta Fed's GDP Now model as we get closer to the second quarter report on GDP, which will report on July 28th. The largest downward revisions on the Atlanta Fed's model were to construction spending and ISM manufacturing, which went from a positive 1.3% to a negative 2.1%. Also, manufacturing and auto sales went from positive 0.3 to a negative 1.8%. Everything else has essentially been a wash, and now they're effectively estimating GDP to come out at a negative 1.9%, which would create 2 straight quarters of negative growth, hence the technical definition of a recession. The second thing we learned, all this recent recession chatter reminds us of the old Yogi Berra line that says baseball is 90% mental and the other half is physical. Since quarter one, US GDP was negative 1.6%, a negative quarter 2 report would fulfill the common definition of a recession, 2 straight quarters. The initial jobless claims data is anything but indicative of a recession, however. Really good job numbers coming out, including this morning. Still, that has not stopped the headlines of recession is here, should the July 28th GDP report show another negative number, as the Atlanta Fed model predicts. Will businesses, consumers, investors alter their behavior as a result of that news? Hard thing to answer, hard to say, but we will likely find out at the end of this month. The third thing, the World Gold Council was out with its mid-year review Thursday morning. The report is remarkably even-handed for a trade publication, listing the obvious bullish points for the yellow metal. Inflation's here, maybe have to deal with stagflation. But surprisingly, they also highlighted the challenges, the right challenges in our opinion. Declining consumer demand in a global recession. People should want gold in a recession. It's declining. And a strong dollar. This has been my argument against gold for a long time. You've lost an entire generation of buyers, with younger generations flocking to crypto instead of flocking to the yellow metal. The third thing we've learned this week. Consumer Reports recently released the result of its nationally representative survey of 8,027 American adults on their views towards electric vehicles. Here are the major takeaways. On buying and leasing an electric vehicle, only 14% of respondents said they would definitely buy or lease an electric-only vehicle. About half of the respondents, 57%, said they would consider, or maybe seriously consider, buying an electric vehicle, and more than a quarter, 28%, said they would not consider buying one at all. The major obstacle to buying or leasing an electric vehicle, you can probably guess it. It's the electric-only vehicle charging logistics, which is to say, where would I get this thing charged if I wanted to go on a major trip or anything like that? So that was actually the 4th thing. I think I said the 3rd, but those were the 4 things that we learned in the markets this week. Now, also head over to our website, whitakerwealth.com. We just wrote a new article that's on the website titled Bear Market, Maybe I Should Like It. And that article really looks at some of the positive things with a stock market crash like we've had. We take a look at a case study we created. Who remembers Ben and Arthur from Financial Peace University? Well, we put a new twist on the Ben and Arthur agenda and look at how Ben and Arthur, who both started saving at different points, actually had better results based on stock market volatility. So as always, if you have any questions, please reach out to your financial advisor. We thank you so much for your trust in us.